Hi, this is Sarah from Accountancy. And if you're interested in running your life and your business as tax effectively and tax efficiently as possible, then this is a video for you. We are going to examine all of the different opportunities available to you to maximize your tax savings before the end of the financial year. So let's get on with it. So first of all, you need to make sure that you're maximizing your personal tax allowances. So the standard personal allowance is 12,570 for the year. And this applies to income from any source. Now, there are some other allowances that you can add to that dependent on your personal situation. But you should also know that the personal allowance is 12,570. It's another use it or lose it allowance. So you can't carry that over into another tax year. So you might as well make sure you're using it. Other allowances include the dividend allowance and the savings allowances. You have different allowances for spouses and civil partners. And of course, you have an ISA allowance. Now, the ISA allowance currently sits at 20,000, although there is talk at time of recording this that might be reduced to £4,000 per annum. So maximise that one if you can. So basically, interest and capital gains within a cash ISA or a stocks and shares ISA are completely free of tax, but it's another annual use it or lose it allowance. Now, the other ones that I mentioned, the dividend allowance, the savings allowance, and the allowances for spouses and civil partners, I'm going to talk about those in a little bit more depth shortly. Okay, so let's start with the little known starting rate for savings. I always have to check that because I have been known to get it wrong. Now, I've got a full video that talks about this in more details. We'll drop that into the messages or the commentary. But basically, if you've got low earned income, so that's income from dividends, pay as you earn, and so on, property for perhaps, but low earned income, but you have got some savings interest, then you might be able to qualify for this starter rate for savings. So that's £5,000 of interest that you can receive every year if you qualify, absolutely free of any tax. And that's in addition to the savings allowances, which will apply dependent on your level of income across the board. Now, if you earn more than £12,570 in earned income, then that rate band is gradually reduced, and it's actually reduced pound for pound. So for every pound you earn over 12,570, you lose one of those £1 from that £5,000 starter rate. So if that could apply to you, if you can be flexible on your earnings, it might be worth playing around with things and seeing whether you can maximise that allowance. As I say, we've got another video on it, so you can turn to that. Capital gains, it's another use it or lose it allowance. So capital gains has become even more important now because the capital gains tax exemption has been cut right down to £3,000 per annum. It was £12,100 per person. It then reduced to £6,000 per person. It's now a measly £3,000 per person. But it is possible and important for you to consider whether you might want to make use of this allowance, because again, you can use it each year and then you lose it. But if you have a gain and you can sell something to crystallise a gain of up to £3,000, you won't pay any tax on that. You might also want to think about whether you have any losses that you might need to. So if you've got investments that are loss making, it might be worth selling some of those to crystallize those losses to carry forward against future gains. So it does take a little bit of thinking, a little bit of pre-planning, but definitely worth doing. Be careful though, if you sell assets at a loss and then want to buy them back, there are rules around what's known as bed and breakfasting. So I'm not going to go into the details of that here, but be aware you can't sell shares and buy back the same shares within 30 days or you'll be heavily penalised for that. Okay, what else? Let's talk about limited company directors and shareholders. So there are some extra opportunities for planning for you. If you're a limited company shareholder, you can of course remunerate yourself predominantly by the way of dividend. Now the dividend tax rates are lower than the income tax rates. So the dividend allowance, which used to be £5,000 and then £2,000 for quite some time, is now, I'm afraid, only £500 of dividend income that you can get at 0% tax. But then for the dividends that you take within your basic rate band, you're taxed at 8.75%. For dividends within for higher rate taxpayers, then any dividends that you take will be 33.75% tax. And for additional rate taxpayers, that increases to 39.35% tax. So it's still less than the tax you would pay on income in those bands, being 20%, 40%, 45%. However, you do, of course, have to take into account the impact of corporation tax that the company will pay, because, of course, dividends are only allowable after tax paid profits. If you've got room in a lower tax band, you might want to pull some of those, declare some dividends before the 5th of April. You might also want to, if you are a business owner and you have family members who are maybe on lower tax bands, you may want to issue them a dividend before the 5th of April to maximise their basic rate band or higher rate band, and while staying out of additional rate tax bands. Okay, so still looking at directors and shareholders of limited companies, I'm sure you've all heard of your director's loan account, otherwise known as your DLA. Now, director's loan accounts can be complex for people to understand. It's essentially a paper bank account for your business and a way that accountants account for your drawings from the business or personal expenditure from the business or any loans that you make to the business. We do have a video on director loan accounts, and again, we'll post a link to that in the comments for you. So director loan accounts, if the company owes you money and the cash is available, you can draw that cash down absolutely free of income tax. It's owed to you, of course. If you have loaned money to your business for some sort of investment or startup capital or working capital, you can also charge interest on that loan. And again, there'll be a separate video exploring the detail of that, because it's still got to be recorded and treated correctly. So you can also borrow money or take a loan from the company, but this is really, really important to be clear about it and plan for it properly. So if you owe the company more than £10,000, that will be treated as drawings, and actually there'll be extra tax and national insurance contributions to pay on that. So you've got to be very, very careful, and or potentially put a loan agreement in place where you pay interest to the business on that loan on commercial terms. The company would also have a tax bill to pay unless you repay the DLA, regardless of how much the DLA is, within 9 months of the company year end. So there's lots to factor in. Check out the other video on this. But a lot of you, if you're a director shareholder of a company, will have room to plan for your year end. The big one really that's left for company directors and shareholders, and for certain employees too, you might be able to talk to your company and do this, and we'll come to this later, but making company pension contributions. So if your business makes employer pension contributions, these are not only a tax deductible expense and allowable for corporation tax relief, so you save that 19 to 25% corporation tax you would otherwise pay, but also there's no national insurance or income tax to pay on pension contributions. So you just need to make sure that you've ticked all of the boxes, dotted the I's, crossed the T's. The money must leave your business bank account before the end of your business year to be allowable for corporation tax relief in that year. It must also be with your pension company in their bank account and acknowledged as such before the end of the fiscal year, which is 5th of April every single year. Hopefully that makes sense. What's next? Inheritance tax. So again, we do have a full guide on inheritance tax, although things are changing, and things are constantly changing. The budget in October 2024 announced some further changes to inheritance tax, which will come into play further down the line. We'll talk about that separately. However, there are just a few things to think about. And while for a lot of you, I hope inheritance tax planning seems like it's a long time away, just planning a little bit now can really make a difference. So for example, gifts made more than 7 years before your death fall outside of your estate for inheritance tax. So if you can make a gift to, well, anyone, and as long as you have survived the giving of that gift for 7 years, there will be no inheritance tax to pay. There's a sliding scale of repayments due if you do not outlive that gift by 7 years. But you need to make sure you keep really good documentation around that. So there's also a £3,000 annual gift exemption, I suppose it would be called. So you can carry that for 1 year if it's not used. So for example, if you didn't make any gifts last year, you can potentially make £6,000 worth of gifts this year, and they will not be subject to inheritance tax. So very, very useful if you have children or relatives that need some support and help, that you can gift this. But again, keeping paperwork in line with this is really essential too. There are some additional gifts you can give if it's for a wedding or special occasions and so on. But again, you can look at the detail of that in a link I'll pop in the comments or the description. Spouses and civil partners, of course, have their own separate allowances, which you need to be aware of. Further down the line, there will be gifts that you could make out of what's known as surplus income. So if you can prove to HMRC that you do not need, you've got this surplus income that's coming perhaps from previous investments that you don't need to live off, then these could be considered exempt from inheritance tax. But again, proper record keeping and proper advice from a qualified tax advisor is really essential on this. Then there's certain other gifts, such as those to charities, political parties, or for the care of elderly or dependent relatives. These are completely tax-free, no catch, no limit. Gift aid, one of my favourites. A lot of people forget that gift aid costs you nothing apart from a little bit of time and energy to fill in the forms and tick the right boxes. So if you remember to tick the gift aid box on your on any donation that you make, as long as you've made that donation personally, not through your business, you tick the gift aid box, the charities get an extra 25 pence for every £1 you donate, which makes a massive, massive difference to them and costs you nothing at all. Hire an additional rate taxpayers as well. So if you're a 40% or 45% taxpayer, then you can claim back extra tax relief on your donations via your self-assessment tax return. So again, that can reduce your bill for this year. You can also carry back donations that you might have made into the previous year, and then you get that benefit straight away. So that's always good. Okay, what else is there? We touched on this at the start. You can claim marriage allowance. So again, if you're married or in a civil partnership, you might be missing out on marriage allowance. Now there are, as ever, rules around this, and we have another video on this the channel that talks about marriage allowance in depth. And actually there are lots and lots of questions relating to that video. So you'll see that we've answered all of those questions wherever possible. And hopefully you'll get all that you need to understand from that. But essentially, a lower earning partner can transfer up to £1,260 of their personal allowance to their spouse, and this can save up to £252 of tax each year. You can backdate it for 3 previous years, meaning you can claim 4 years altogether if you happen to be in that position. So definitely one to look at. Be very, very careful though. We have seen some real scams around marriage allowance, so be so careful if you're doing this online and an ad pops up. Do not click and fill in your details. You could be at risk of being scammed. Be careful. Child benefit tax charge. Yeah, got to avoid that trap if you can at all possibly. Thankfully, the government have seen a little bit of sense, and the high income child benefit charge has the threshold at which that starts to kick in has been increased. So that is affecting now individuals with an adjusted net income more than £60,000 per annum. And it increases gradually for incomes between £60,000 and £80,000 per year. And at £80,000 per annum, that child benefit is fully withdrawn. So you be aware of it. If this is going to apply to you, it's much better to stop receiving the benefit rather than getting that hit of having to pay it back. That's always a bit painful. And HMRC doesn't always act in a very timely manner with relation to this. So sometimes we've seen people who have had to pay back 2, 3, 4 years of child benefit all in one go and all under duress in a certain timeline. This is where potentially as an employee, talking to your employer about making additional pension contributions in the short term to bring you under that threshold might be an option to sacrifice some of your salary into a pension. That reduces your take-home income and therefore keeps you out of the charge. Speaking of nice employers, some employers will operate salary sacrifice schemes, and these workplace benefits can be a really good way of maximising what you can get without big tax costs. So if it's salary sacrifice, you could have pension contributions. There are also cycle to work schemes or even electric car leasing, which can therefore reduce your taxable income and save you some tax. Not only does it reduce your taxable income, you'll also get the national insurance saving on that too. So a bit of a win-win. What about if you're self-employed? Slightly different rules for people who are self-employed versus directors and shareholders of companies or other individuals. But you should make sure that you're claiming all of the allowable expenses available to you, such as home office costs, professional subscriptions, or purchases of equipment. That's something for limited companies as well, of course. So, you could consider bringing forward purchases. So if you're a sole trader, consider bringing them forward to before the 5th of April each year. If you're a limited company, you want to consider bringing those forward to prior to your year end, your company's fiscal year end. Could be new equipment, might be new laptop, video recording equipment, business insurance, all sorts of things that you can potentially commit to and contract for and bring forward to prior to your year end, saving you either corporation tax or personal tax if you're a sole trader. I think that's probably about it for now. There are changes coming in April 2025, which means that national insurance contributions, the employer's national insurance contribution is increasing from 13.8% to 15%. So some of you may wish to consider, if you have staff bonuses, for example, to pay, as to whether you could or should bring those forward into March rather than paying them out in April. But again, there's a fine balance. There are lots of things to consider there, like whether you're then maybe bringing somebody into a higher rate for 1 year and a knock-on impact that might have for their tax, or indeed for your tax in the company. I'll post a link as well to the Gov site for the latest tax rules all around this. Just a final thought, if you want a complete review of your pensions, investments, potential gains, you should do that. You should do that on a regular basis with the right professionals to make sure you're getting the best possible advice. Probably the biggest takeaway that we can give for both individuals, employees, and directors or shareholders of companies is that the pension contributions are the best tax planning strategy you can put in place. They still attract relief currently at your highest rate. So, for example, if you are earning over £100,000 because of the withdrawal of the personal allowance, once income's over £100,000, you're facing an effective tax rate of 60%. So if you can introduce more into your pension to reduce that earned income below the £100,000, there's quite a substantial saving for you. The current allowance annually for pension contributions is £60,000 per annum, and there are still carry forward years that you could potentially use, but you need to be mindful of the tapering for those highest earners out there. So I think that's it. Any questions, we'll be happy to answer. Thanks very much.